Good morning. Today is January the 13th, and this is another episode of Two Grey Beards. Well, we've had a bit of an interesting week, and we've had CPI, we've had PPI, and the market still likes itself, doesn't it, Andy?
Sure does. The broad asset market is basically unchanged for the year with TLT down and the equity markets modestly up after a sell off in the first week and then a bounce. But the story's not about long term assets right now. It's about the very short end of the yield curve and the pricing of a significant amount of cuts in the relative in this following year in 2024 getting priced into markets. And I'd like to congratulate Nick on this call. The move from money market, mutual funds, cash like items to 3 to 4 year bonds was exactly the move one should make ahead of what has happened. And so why is that? And was that the right move? Nick, why don't you describe, what's going on?
Right. I've seen this a few times in my career. Let's start with what the Fed has said. And the first person who said it was Powell during one of the FOMC conferences, where he described or answered a question from a journalist as to why they had the lower dot plots in 2024 and then 2025. And he correctly said that if inflation falls back towards target, unless they eased, they would be tightening, because real rates would go higher and higher and higher. Then Waller came out a couple of months back and stressed that, emphasized it. And then finally the market started taking notice after the last FOMC. What the market is betting on at the moment, and the market might well be correct, we don't know yet, data will prove or disprove, is that the inflation rate, the core inflation rate, will fall to somewhere between 2.3 to 2.5% this year, and that will enable the Fed to cut rates to something like 2% real on Fed funds. So if we are talking about 2.2, 2.3 core inflation, then we are talking about Fed funds rate no higher than 4.25, but the market always pushes for more. Now, do we know that 2% is their target, 2% real? No, we don't. It could be 175. I certainly don't think it's lower than 1.5. So that gives us an idea of where they would like to have the real Fed funds rate and where they consider the real Fed funds rate to be neutral or even slightly restrictive. Because I don't think that they want the situation to be accommodative, because there is absolutely no reason for that. GDP is strong, unemployment is low. There are there are some pockets of weakness in the economy, but overall, no number that comes out about the real economy is showing any danger of the economy falling into recession anytime soon. And therefore, there is absolutely no need for accommodation. What there will be is a need to reduce the real level of interest rates to accommodate for the fall in inflation, which, at a guess, and economists are going to debate this for many years to come, was 80% supply shock and 20% excess demand. So if it was that kind of a ratio, and who knows what the real ratio is, and let's not bother even getting into it, that means that if 80% of the inflation was a supply shock from COVID and the, to a lesser extent from the Ukrainian-Russian war, then we are at a situation where it's safe for the Fed to reduce that portion which has been taken out of inflation, and not accelerate demand as a result. If that's the situation, it is not ridiculous to look for rates somewhere in the 375 to 4 to 4.25 level in by the end of the year. Now, how does that translate into what we have done? It is very unlikely that people are positioned correctly for this move, and it's very unlikely that they are positioned in enough size, i.e., a lot of people are still trapped at 5.25 in 1 month bills, 2 month bills, very short end, and their reinvestment risk is enormous. So at some stage, and I guess they're hoping against hope that they get a high inflation number 1 month, the market comes back so they can re enter and get rid of the reinvestment risk. And I think that we are positioned exactly right in the right portion of the curve. Because if the Fed funds rate is going to come down towards the 375 level this year and possibly 325, 3% in 2025, then our threes and fours will be going down the curve. We will be picking up positive funding and sliding down the curve. That is something that I think is the correct position to have. And I see absolutely no reason to get rid of that position, even though now we're trading at 380 on the stuff that we bought at 425. But I still don't see that the risk reward favors getting out of this, because what would we get into? And that is the dilemma that the market has at the moment. And that is why the short end is doing nothing but appreciating, because there is no better alternative. There is no better risk reward. There will be one once some thesis that the market currently has is disproved by data. But at the moment, there is absolutely nothing better.
Right. And that's why we're in it. We have long-term assets. We have no TLT. We'll get back to that. We have some stocks because we think stocks should be owned, and we're medium in our equity exposure. But we're struggling to find places to put money outside of this very narrow sector of 3 to 4 year duration. And that's where all the action is. And I agree with Nick. The issue that I have, and I've been saying that inflation is going to be harder to reach target than it has been. And I still have that view as a macro view that the financial conditions and the size of the bank reserves and money sloshing through the system could be inflationary, as well as the very large budget deficit. But one thing for sure, it's been supporting real GDP. And so you look at what's happening and you see the inflation coming down, you see relatively stable to fairly strong real GDP. And the question will be, will inflation continue to go toward target? And for now, there's no reason to believe it won't. And that's the big issue, which is, what will it take for the market to stop believing this disinflationary trend? And so I look to the Fed, and I look at what the Fed said in December, and I look at the data since December, and then I say, what would I do if I were in the Fed's shoes? Now, there are a lot of cuts being priced in, which is having an easing effect on financial conditions. There's a big rally in markets that have had an easing effect on financial conditions. And so somebody might say, well, they're going to push back on that and cause short-term rates to once again go higher, or assets to fall. But the question is, why would they? Like, why should they push back until the data heats up? And so far, we haven't seen that. So I would expect in January, when we have the FOMC meeting, that the Fed doesn't change its position, that it says what it said, exactly what it said in December, and possibly even a little bit more dovish than what it said in December. That there's no reason, there's no motivation for them to push back. And so I think about what that means for market participants. Market participants are going to think the same thing until data changes. And so it is data dependent, but the direction seems clear. No change, continued easing of financial conditions, particularly in the rate space, until data changes. And so the question is, Nick mentioned, should we be selling our threes and fours at 380? Well, firstly, we'd have to have something to go into. Cash doesn't look like it's going to pay. It looks like there's reinvestment risk. And so, okay, so let's assume we had something. Well, okay, great. Now, when would we get back in? And would we be able to get back in at 4.25? I think the data would have to radically change for threes and fours to once again be at 4.25% yield.
Absolutely.
And why not wait?
Yeah, no, absolutely. And if I can just add, it's telling to me the way the market has been trading last week. Last week, we had a CPI number which was very slightly in excess of market expectations. And we spent a couple of hours slightly down on prices in bonds. And then by the end of the day, we rallied. And really, the reason why we were down is because that day we had the 30-year auction and participants were preparing for that. And as soon as the 30-year auction was out of the way, the market started rallying, even on slightly worse than expected numbers. And then on Friday, we had PPI, which was ever so slightly better than market participants expected. And that's really because oil was down in December and so were all the other commodities. And we knew that. It's not like that was something new to us. And the front end started rallying, incredibly, 16 basis points at the very front end, which tells me that people are caught. People are underinvested in the belly of the curve. They have a huge reinvestment risk, and any opportunity they get, and the only opportunity they're going to have is through issuance of more paper in that part of the curve. And that is what I would do if I were Janet Yellen. I'd let them have some. But here we are in a situation where any pullback is going to be very limited unless the data is very, very bad. It doesn't need to be a little bit bad. It needs to be crushing enough to change the narrative.
Yep.
And we're not going to get that for a long time to
Inflation
come. Yeah. And what do we have? We have core PCE coming out mid 20s in January, right? 23rd, 25th, I can't remember now. And then we have the FOMC, and
26.
then we have the QRA. So really, there is nothing there that's going to change the narrative. And I agree with Andy. I don't think the FOMC is going to change the narrative. The only thing that might change pricing is the QRA, but we will prepare you for that, which means that between now and the QRA, the odds of market prices being significantly different from what they are now is very low.
Right. And let's talk about longer term assets. We've focused your attention on the short rates. And I got to tell you, it's a pretty boring area for you as long term investors. Like Nick made an extremely intelligent trade moving out to um, threes and fours. But this isn't going to make your year. It's going to make you a little bit on your what would have otherwise been your cash. What makes market returns, what makes outperformance is the capital appreciation or depreciation of long-term assets. And so let's talk about long-term assets. And right now, what we have seen, and it's really been about 6 months now, that TLT, long-term bonds, and equities have been moving in perfect lockstep. They went down together in Q3, they went up together since Halloween, and they've been basically unchanged in since Christmas. Why? Well, the drivers of these assets just aren't moving that much. And pricing of equities is fairly robust in terms of expectation of earnings. Inflation expectations for bonds are fairly anchored. And all the action that's causing any bond rally and stock rally is because the front end is getting a little lower in yield. And so when I look at long-term assets, I just don't think there's much to make in being long them. And at the same time, there's probably not much to lose being long them. And so they are fairly stable,
Yeah.
absent a big change in issuance, which we'll talk about as we approach the quarterly refunding.
No, absolutely. The and if I can just stress, the whole move in the bond market is pivoting around the long end. It's the short end coming down and the yield curve disinverting. The one thing I would like to add is this. Always when the yield curve was inverted, the signal for the start of a recession was the disinversion. And that is because the Fed cut rates, because they saw real data telling them that GDP was falling, unemployment was rising, and that the recession was close. That is just not the situation that we're in at the moment. So don't take this disinversion as a potential sign of equity trouble ahead. That is absolutely not the situation at the moment. The situation at the moment is, as I described, we had a supply shock, which is now being taken away, and we are getting normalization of real rates. Completely different story from 2008 or from 2000 or early in 1992-93. This is completely different. I would not consider this disinversion which is taking place to be a harbinger of bad news for equities at all.
Right. And I'll even go further and say many times that the disinversion, meaning the fall in 2-year rates versus the longer end of the curve, has not only has it led recessions in the past, it's usually been the reaction by the Fed to a financial stress.
Correct.
And so, and it's all been about either financial stability or real growth falling. And this disinversion is 100% about, so far, 100% about disinflation, which is not financial stability, which is not real GDP. Now, it's possible that and thus that people call it a soft landing. It's possible that we do have a soft landing and neither financial stress occurs nor real GDP falls and thus unemployment rises. It's possible that that happens. And if so, it's going to be a pretty boring year. On the other hand, it's also possible that neither of those things happen and we actually get a real GDP fall or a bounce in inflation. And those are outcomes that will cause us, when they become more clear, cause us to shift our long-term asset allocation in one way or the other. But at this stage, our long-term asset allocation favors shorter-term bonds, long equities, and there's really not much reason to change until either data changes or issuance changes.
Great. So, in the short term, what shall we do? What is there to look forward to next week, Andy? What do you think might happen?
Right. So we don't have any. We have no issuance. Data is secondary data by and large. Of course, the jobless claims number will be a focus. One of the things that is always interesting when short-term yields fall dramatically, is to look to spread product, credit spread product like HYG. So, you know, those things have rallied a lot too. HYG has rallied both on treasuries falling, it's a relatively short duration, treasury yields falling, it's a relatively short duration asset, but also credit spreads narrowing significantly. But nonetheless, there may be some demand for the people that missed the threes and fours like Nick got, like we got, and chasing higher yields. And so I think buying the dip on HYG in the near term ahead of any supply might be an interesting trade.
Yeah, no, there's so little data coming out. We do have some earnings from, Microsoft and stuff like that in coming up soon from the Magnificent Seven all the way
Next
into
week,
February. So, but that is not going to be market moving in the immediate future, and certainly wouldn't move something like HYG. I will talk about HYG in an interesting potential trade that we are going to do. We're going to put in an offer and see what happens. I'll talk that in my segment. Right. So I do think that the likelihood of the market retracing significantly in credit products over the course of the next couple of weeks before the QRA is very slight. And therefore, selling puts against those products, although not hugely profitable, is going to enhance the return. And we also would like something like HYG, because let's see what kind of picture are we painting here? We're painting a picture of stability where the long end is going probably nowhere in the short term, not before we know what the supply is going to be in the future months from the QRA. And therefore we think that equities are not going to go anywhere. We think that credit is not going to go anywhere. And any kind of a pullback in TLT or in credit or in equities is going to be slight and a buy. Therefore, I think selling puts in HYG is probably the best thing that we can do at the moment.
I agree. Not much, but it's something.
Great. Thank you very much indeed. See you next week. Let's have a look at the portfolio. Well, we are back to slightly above the start of the year, so that's not bad. The monthly performance is here, and you can see the exact number. But let's talk about what is making this return. It's all these bonds. It's nothing else. The SPY is unchanged, QQQ is slightly down, the Dow is slightly down, so none of the performance is coming from the equities, and this is really apparent. They are going sideways. So let's have a look at the only trade that I've put in here as an idea, and this is what we're going to be selling. We're going to be selling to Jan 26, the at-the-money puts in HYG. As we explained, HYG is credit and duration. The duration is somewhere in the belly, so we are happy with that. And therefore, we think that the move down, if there is a move down in HYG, is going to be very limited. And if there is one, we want it. We might change our minds after the QRA, which is on the 31st, but we certainly won't change our minds before the QRA. An alternative for you would be to sell the option to Feb 2nd and then cover it just before the QRA. That is a perfectly reasonable option, but I prefer to do this because it just involves less time and less thinking. It's simple, it's quick, and it's a limit order at 21. It closed at 19. If we get it, we get it. If we don't care. Basically as simple as that. I hope you've understood what we're thinking and why we're thinking it. All the broker statements are uploaded and you can download them anytime you like. And we really are not going to change this allocation at all until we get the QRA or something like core PCE, which is coming out on the 23rd, I believe, gives us an indication that the current narrative is wrong. Because if it isn't, these belly bonds are going to keep on appreciating. Thank you very much indeed, and have a lovely bank holiday weekend.